Welcome to the webinar, everybody. Great to have another featured topic here with Barry Brooksby, whole life infinite banking practitioner. Great topic today. We put together a really great look into infinite banking versus stock market investments. And what we want to do is a side-by-side to maybe raise awareness, maybe some of the truths about how money actually works. I know Barry is very attuned to putting numbers to these things. So I think we're going to see some exciting things here in the webinar, side-by-side comparisons when you're talking about returns and these kind of things. With that, Barry, thanks for joining us, and I'm excited to get started.
Thanks, Steve. Appreciate you having me. You know, the goal here really, because I get the question often is, well, how does this compare to my 401k? How does this compare to my stocks or my brokerage account? And today we're going to go through it side by side to see it. But I want to share something from a 30,000 foot view, which is this. These are two separate, different types of assets. It is tough to really compare apples to oranges, which is essentially what we're trying to do here, but we're going to do the best we can. What I tell people often is, look, if you're still focused on your stock market investments and you want to be there and you don't mind all of the potential issues with losing money, fine. But you should have another asset in your portfolio that's uncorrelated, that's tax-free and guaranteed. And that's what we get with infinite banking.
Exciting. So, and we talk about it a lot. You talk about having your safe bucket asset.
Safe bucket. So I'm going to share just a little bit of my story. I've been in the industry now 20 years. And when I first got started, I was actually securities licensed. I was putting my own money and my clients' money into the market. And I used to hear from my mentor and other financial advisors within the office that I was practicing in that the market's going to return on average a 10% rate of return. Well, I took that story and went with it. This is what I was teaching my clients. You're going to earn 10% in the market-based investments. But Steve, after about a year, I started to realize that what I was telling clients wasn't coming to fruition. Clients were saying, hey, Barry, I'm not making money. Other clients were saying I'm losing money. And I really started to dive deep into what are the problems with the market? Because up to that point, I was just taking the advice of my mentor and other advisors in the office. And when I would go to my mentor and ask the question, hey, what do I tell my clients? They're losing money. You know, I'm a newbie. I've only been in the business a year. What do I tell my clients? His answer over and over again was, tell your clients they're in it for the long haul. And frankly, that just didn't sit well with me. And it was at that point, I'm like, okay, man, I've got to find something better than dealing with all this volatility. And I'm losing sleep at night. My clients are losing sleep at night. And here's what I discovered.
I wonder how many people listening have heard that before.
This 10% is an average rate of return. And we're going to learn here in a few minutes that average doesn't really mean anything. It's a meaningless number. And the reason is because you have to minus out taxes. You have to minus out fees. You have to minus out volatility. Market goes up, market goes down. We're seeing that happen right now. The market's down about 15% from its high a few months ago. Now, at the end of the day, we have what is called an actual rate of return. And in my 20 years of investments, life insurance, real estate investing, financial planning, what I've seen in other people's portfolios is most people are netting an actual return of somewhere between 2 to 3%. So Steve, they're taking all the risk, right? Yep. The money managers, Wall Street, they have all the money. There's no risk in the investment for them. The risk is put on the actual investors. So all this risk for a measly 2 to 3% return. Yet, what if you retire and the year or two before you retire, there's a market crash or correction and you're negative?
Right.
I mean, there's so many problems.
I've seen that a lot as an estate planner. As people age, you want to make sure their nest egg is secure. And my experience, and I talk a little bit about this in the self-banking blueprint, but just how how I learned of this concept that Barry is an expert at, for those of you listening, it had to do with me understanding that you got to have some predictability in your retirement nest egg. So this goes to the exact issue, Barry, the volatility, the returns, the shifting the risk. I'm not aware of any other asset that the individual doesn't bear the risk.
That's right. And although I'm showing this on a whiteboard, we're going to get into the numbers today, and I'm going to prove it out mathematically, which is very powerful. But as we consider what I learned and what I found to be better, much, much better through infinite banking, I discovered that we really have the opposites of stock markets, because in infinite banking, you're growing your money tax deferred and potentially, if it's done right, tax free. In infinite banking, I would say the fees are nominal, usually 10 times less than what you would see in a market-based investment. And Steve, there's no volatility. Why?
Right.
Because you have guaranteed growth every year.
Yeah,
You never lose money.
And I can tell you, Barry and I both have experience with that. Wonderful aspect of this kind of a strategy is you're not going to have those setbacks with this particular asset.
You can count on it. You can bank on it. And
literally.
And when you have that in your portfolio, there's more peace of mind. There's more security. Even subconsciously, you'll just function better in your life knowing that you have this asset in your portfolio. As far as returns go, the returns do differ somewhat based on age, health, and the amount of premium that a person puts in. But what I see more times than not is a 5% net actual rate of return. Pretty remarkable. And we're going to get into how powerful that is.
I think you got people probably that are wondering how that's possible. So I think it's great that you're going to crunch the numbers.
We will. And we're going to start with an example, an illustration example of an infinite banking plan. This is on a 35-year-old. And we're assuming here that they're putting in $24,000 a year or $2,000 a month. The premium amount that my clients choose is up to them. I have clients, Steve, that are doing $500 a month. I have clients that are doing $200,000 a year. That's an individual decision, but I will say you want to get as much money into this as you possibly can, because there's flexible premium options, and obviously you get all the benefits I'm talking about.
And Barry, let me interject. This is something that a lot of the people that are listening, wondering how to empower themselves financially. And it goes to a philosophy. If some of you guys have listened to or read anything from Kiyosaki whatsoever, he talks about paying yourself first. This kind of a thing can go very well with the idea of paying yourself first, in my experience. And I'm just speaking from how I looked at it, because it becomes a very strong financial stabilizer. Go ahead, Barry. Just wanted to mention that.
I agree with what you're saying. That is a true financial principle, to pay yourself first. And Robert also talks about investing in assets. This is an asset. So you're accomplishing a lot of financial principles by simply having a policy like this in play.
And this is also why we've taken issue with some of the misnomers out there, the buy term kind of things. And Barry, actually, this webinar does directly address the sort of buy term and invest the difference kind of thing.
It does. And we're going to see that play out once we get into the numbers with the calculators. Yeah, exactly. The way I've designed this, Steve, it's high cash value. It's a minimum whole life death benefit of only $284,000 that's being purchased. But the client's getting almost $1 million of coverage based on a term rider and the way I design it. We won't get into the details of that today. What I want to point out, though, is in the very first year, there's over $19,000 of cash value available to this person. Although they've put in 24 grand, the majority of their premium is liquid. So that's pretty remarkable. We fund it for 25 years. So to the age of 60, this $24,000 is the last year that they will pay the premium. So up to that point, $600,000 has gone in. What do they have? They have a $1.2 million tax-free pool of money. Their death benefits grown to 3.3 million. They only paid for 284,000 of whole life insurance. And Steve, starting at the age of 61, they're done funding. No more money going in, but look at the cash value. It's still growing by 72,000 a year, 76,000 a year, 80,000 a year. What 60-year-old do you know today that invested money for 25 years is done and they're earning $80,000 a year in gains?
Powerful stuff, man. This is the high cash value machine in action. This is an actual illustration, right, Barry, that you're basically running through the software. And obviously everybody's case is different, but this is just taking a healthy 35-year-old male and plugging in the numbers.
That's exactly right. And then putting that infinite banking effect on it for high cash value. And we're not going to get into the details here today, but all this money then can be used in retirement as that tax-free stream of income we've talked so often about.
Right. You know, there's other webinars that we have for some of these other topics that you guys can look at if you're interested in any of these things. We just did a thing on policy loans. We've got infinite banking webinars and these other things that dive into these concepts. But that's what we're illustrating. And, you know, hopefully this gets the wheels turning on what is possible.
Steve, what I've done is I've simply taken these same numbers from the illustration, the premium amount, the total cash value, and the total death benefit, and I've put them into my Truth Concepts software. This is called the funding illustration. And what we're looking at here is now the calculations of how these numbers function. So at 24,000 a year over a 25-year time frame through the age of 59, 35 to 59, that's 25 years because we count age 35 as the first year. We see the same 600,000 that's gone in. There's our 1.227 million that matches the illustration exactly right there. Okay, 1.227 million. And you'll notice the earnings rate for this person, Steve, here in the left-hand corner, is 5.14%. That's what they've earned in this policy, is 5.14% every year, even though they're down about $5,000 in the first year and a little bit in year 2 or 3. It truly is as if this 24,000 a year earned every single year a 5.14% tax-free rate of return.
That's powerful. And that's just a calculation, right, Barry? Based upon the totals, the cash value that the illustration is providing. It's pretty straightforward.
Right. Yeah, so we can actually put it into a rate calculator here. We do the 24,000 a year with a future value of the 1.227 million for 25 years. We get the exact same number.
There you go. That's your internal rate of return every year.
You got it. Every year. That's what we want to emphasize. Not just in 25 years, but it is as if you earn 5.14% every year.
When you talk averages, that's not what you're doing, right?
That's right. This is not an average. This is an actual return of 5.14% every year.
Every year, yeah.
Well, Steve, look, the market doesn't do that. There's what we call sequence of returns, and I'm going to show you that here in a minute because we want to compare this to a market-based investment. But before I do, let's take this out to the age of 70. Remember, they're done funding after 25 years, but if we go to age 70, we even bump up the return higher. It's almost 5.4%. And the cash value at the age of 70 is now 2.27 million with a 3.9 million death benefit. So to be fair, I'm going to copy the 5.39% numbers with all the decimal points here, and we'll make an assumption that the stock market investment, we'll call it a brokerage account, and in this brokerage account, someone could be investing in stocks or mutual funds or ETFs. We'll make the assumption that that alternate market-based account is going to earn that 5.39%. All right.
Mm-hmm.
But here is where we start comparing the two: stock market investment versus infinite banking. If you're in a brokerage account and you're investing in mutual funds or stocks, you're going to get a 1099 tax bill from the company every year on your gains. If there are gains, you're going to get a tax bill on the gains. So we're going to click here, the income tax on earnings. We're going to show 30%. The reason I'm showing 30% is based on marginal tax brackets plus any state income tax. And for most people, they might think that my 30% is actually low. You're in California, you're paying probably 13% state tax and who knows what federal, right?
Yeah.
So I think this is very fair to show 30% tax. Well, what that means, Steve, in the left-hand corner here at the bottom, you would have to earn 7.7% every year in your market-based investment to net the 5.39% in the life insurance policy.
Just because of the taxes.
That's right. But we're not done. If you have a brokerage account, you're also paying a management fee. You might even be paying some additional fees inside of the mutual funds you're purchasing too. Now, we could go off on a tangent here, and I've heard Jack Bogle of Vanguard say fees are 2% for most people. We could look at a Forbes article that say fees are 3.5% to 4%. But I want to be conservative. So the management fee we're using today is only 1.5%. You'll notice what that does here in the bottom left-hand corner to our rate of return. You would have to earn 9.34% every year. I'm going to keep emphasizing this, every year without ever having a down year to net 5.39% in your infinite banking plan.
Wow. So the plot thickens, so to speak.
The plot thickens. See, the point we want to make here is, one, the market doesn't do that. We've emphasized this. I'm going to continue to emphasize this. And it's because of the sequence of returns. I'm going to show that to you in a few minutes. But the market doesn't earn 9% year in and year out.
Right.
But Steve, we're not done. We're going to thicken this a little further. And that is the conversation we've had often, that most advisors are talking about buying term insurance and investing the difference. So I'm now going to pull in the term insurance cost, and we're simply going to do term insurance for $1 million on a 35-year-old for 30 years. It's about $900 a year. There's the $1 million death benefit for 30 years. Adding that additional cost of $900 a year now gives us an effective rate of return of 9.58% that you would have to earn in your market-based account every year to net 5.39 tax-free.
Wow. Barry, some people watching might say, well, how did we, they might be getting skeptical, of course, and I would hope people would ask tough questions, but how did you come up with and this is just the internal rate of return of the policy, right? Based upon both the guaranteed return and then the dividends in the policy that are projected?
That's correct? Yep. I didn't manipulate any of the numbers. What I have came directly from the life insurance company. These cash values, this death benefit, we got to 25 years. There's our 1.227 million. We get to 36 years out. There's our 2.27 million. So these numbers are always growing, but you are correct. It's based on a 4% guarantee of the life insurance contract from the mutual insurance company. They pay the dividend in addition to that. The dividend portion is not guaranteed. And that's why we see this as a non-guaranteed portion, but recognizing that 4% of it is guaranteed. Now, you do have to minus out the insurance costs, but you can see here, if you've put in 600,000 through the age of 60, and at 65, you've now grown to 1.6 million. It almost appears that you got a $3.3 million death benefit for free. We can't say that. It looks like that on paper because there is a cost for it, but it's remarkable that you've got, $1 million more tax-free than what you put into it and a $3.3 million death benefit.
Yeah, and Barry, there's so many things going on, right? You've got these dividends, but they're also tax advantaged because they're looked at as a return of premium, right?
Correct.
So this policy, I would say, that, it's lean and mean because it's got dividends going back into it, which is returning, which is really your mutual company returning proceeds, And so we talk about mutual versus stock companies. The other thing you didn't mention is that after a certain age, on the term, we added that cost in, but after 64, I think was the age that you had, or 65, that life insurance cost is going to continue to skyrocket on the term side, right? Where it's pretty much paid up on our whole life side.
That's correct. And if we do a death benefit comparison, this is pretty interesting to see. Here's the alternate investment account with the term insurance. You only come out ahead on that alternate investment account in year one. That if you died in year one, yes, you would have got more. However, year two forward, the permanent insurance is always going to be higher because it's a permanent death benefit. And then here's the difference. If you pass away at 66 or 67 and that term insurance goes away, well, you only get what's in the investment account, which is the $1,016,000 here. Right. Where in the permanent death benefit, it's $3.6 million that would be paid out to your heirs. That's a $2.6 million difference.
Wow. And so if I look at this holistically for the benefit of the people listening, now, even just if we went with the guaranteed portion of the policy, which isn't realistic because you've got a couple hundred years worth of dividends that you're basing this on, right?
Correct.
But even if we did, you've got to make 9.58% every year in your traditional or stock account, whatever it is. And we're not even factoring in down years there.
Not at all. That's right. So now here's the comparison. We look at cash on cash, alternate investment account compared to the life insurance policy. Steve, I get this question often. Well, Barry, what's the downside? I see so many pros of infinite banking and permanent whole life insurance. What am I missing? The only thing I ever tell clients, frankly, the only downside is this is not a short-term play. If you come to me and say, hey, Barry, I've got $100,000 or $500,000, I want to invest it with you in one of these policies for 3 years, I'm going to tell you, look, this isn't for you. And I'm using a blanket statement because sometimes there are some things we can do, but this isn't a short-term play. It's a mid to long-term play, meaning you want to be in the policy at least 7 years, 10, 15, 20, 30 plus, but it isn't a short-term play. And we see that here. In the first 6 years of the policy, we do see that the alternate investment account is performing better. But starting year 7 forward, look at the difference. The permanent insurance, infinite banking, these are the numbers as to how much you're ahead. And obviously, because of the compounding effect, you're always pulling ahead. And again, we're assuming you could earn 9.58% in your alternate account, which we know isn't going to happen.
Right. I guess that's the thing I keep coming back to, because I think this is very generous to the alternate account.
Yeah, I'm trying to be fair. We could really blow this up. I could show 2.5% management fees. I could show a 35% tax bracket. I could put volatility into it. But you're right. Well, it's generous. It's fair.
Well, one thing I really have always thought, Barry, is that, this is like when you illustrate whole life, particularly with the companies that we carefully vet and you have over the years, it's like looking at a projection on a very modest day, right? Versus kind of looking at sort of stocks and things on their best day, because that's sort of what happens. I mean, let's be honest. I mean, when you're saying that average returns are 8, 9, 10, 12%, which is very common, it's being very generous. I'll just put it that way.
What you've just said, Steve, is a great segue for what I want to share next. A lot of the investment accounts will use a 20-year history. They'll look back 20 years and then project those returns forward into someone's financial portfolio. That's not how a life insurance company works. If I did that on the illustration we're using today, the numbers would be even higher. But all we're doing in the illustration today is taking today's dividend and projecting it forward, not a 20-year look back.
There you
But
go.
what I have here in front of me, and I'm going to show you this other screen real quick, this is the 20-year history of the S&P 500. This is the best of the best index in the industry. You notice it's only averaged 5.6%, not 10, not 12. Yes, there have been some years that have done extremely well with double digits, but the fact of the matter is it's a 5.6% average rate of return.
Yeah, I just want to jump in on that real quick, Barry. So, and there's things happening within that return, right, too, because if you lose 50% of your account and then you get 5.6% on average for the next 10 years, it's going to take longer to make up that account, right? There's some math that goes on in that.
That's correct. And we call this the sequence of returns.
Okay. Mm-hmm.
When you have a losing year, it's a steeper slope that you have to climb back up to get back to even. I still talk to people that lost money in the crash of 2008. It took them 9, 10, 11 years just to get back to where they were before the crash.
Mm-hmm. Mm-hmm.
And we see that here. What I've done is I've simply copied those 20-year historicals and put them into my calculator, but now we're using real money. See, an average rate of return, Steve, you heard me say in the very beginning of our webinar today, average is meaningless. Where it really comes into play is when you start putting real money into the numbers. So what I have here, I've built a portfolio. We show an initial present value of $1 million. And this person then continuing to put $24,000 a year into their investment account, similar to what we were showing in the infinite banking plan. But watch what happens when I click this button that says show ROR. It's going to show us the average rate of return of 5.6%, but look at the actual rate of return.
Because
only
of the
4.7.
Right, because of what you just said, the sequence of returns.
That's right. When you put real money into the numbers, it changes the actual return. Now, you remember when I started off telling you about my story, I really got a glimpse of how the market works. I wanted to figure that out and find something better. I'm going to show you here what I mean by most people are only earning 2 to 3%. And I would say that's still being optimistic. If we put in that 1.5% fee, it's eroded to 3.2%. If we put in that 30% tax bracket, it's 2.5%. So you have to ask yourself a question. If you're investing money in the market, at the end of the day, are you doing all that to simply earn a 2.5% rate of return? Probably not. So be aware of the typical financial planning advice out there, because of what I've seen in my 20-year career is it doesn't work for most people. Now, sure, there are some anomalies out there, Steve, but it doesn't work for most people. What we want to educate people on is infinite banking, safe, guaranteed, liquid, tax-free, predictable, more peace of mind in your life. And frankly, you're going to probably end up creating a lot more wealth too.
We didn't really factor in the intangible value of like 20 years of peace of mind yet. But but the other, so I mean, I'm actually, it's fun to laugh about it, but I actually kind of mean it truthfully in terms of health and things like that.
Yeah, Steve. So as we wrap up the webinar here, coming back to our net result, to earn a 5.4% rate of return in your life insurance policy tax-free every year, you would have to earn 9.58% in a market-based account, which we know isn't possible. So my point is, how good is whole life insurance? How good is infinite banking? It's remarkable. In my opinion, it is the most powerful financial tool in the industry. And this is what we want people to recognize. Look at your own numbers, find out what works for you, and let's put a plan together, a design together that you can really go out there and crush it, knowing that you have all these benefits in your portfolio.
Awesome, Barry. And I just want to say powerful, predictable. There's a lot of different aspects to it. Incredible. Thank you, Barry, for a great breakdown by the numbers I think a lot of our visitors and clients and people out there just wanted to see that. And I hope you guys get a chance to look carefully at those numbers and consider it. Barry, of course, is available if you guys are at a point where you want to see your own numbers, you want to see your own policy, see a breakdown of how your budget and everything could work this powerful concept for you and your loved ones. Click the link below. You fill out just a real brief questionnaire to give Barry an idea of how to best look at your situation. You can access Barry's calendar below and get started. Thanks again.